Today, we're going to perform an autopsy on one of the biggest economic earthquakes of our lifetime, the 2008 financial crisis. We're going to dig in and try to understand exactly how a system that was supposed to be stable could just so spectacularly implode, and, more importantly, why we're still feeling the aftershocks today.
To really get the feel for that moment, you have to start right here. September 2008, it wasn't just a bad day on the stock market. It felt like the entire global economy was having a heart attack. The credit markets, the actual lifeblood of business, they just froze solid.
And that really brings us to the core mystery we're trying to solve. The thing that triggered that heart attack was the collapse of Lehman Brothers. Now, this was a company that survived the Civil War, the Great Depression, basically everything. So how did it just vanish? To get the answer, we have to unravel a pretty wild story of financial engineering, pure greed, and just some catastrophic mistakes.
So let's set the scene. It's the morning of September 15th, 2008. There had been this weekend of just frantic, last-ditch negotiations to save Lehman Brothers, but they all failed. The company files for bankruptcy, and just like that, the invisible plumbing that makes the whole world's economy work, it just bursts.
The sheer scale of this it's just hard to wrap your head around. $639 billion in assets. It was and still is the largest bankruptcy in American history. But it wasn't just a big number. It was a shockwave. Instantly, banks all around the world stopped lending to each other. Why? Because nobody knew who was holding the toxic stuff. No one knew who was safe. So the whole system just seized up.
So, how in the world did we get to that point? Well, the seeds of this disaster were actually planted way earlier, with some clever financial inventions that completely changed the way banking worked. They basically turned your simple home loan into a complex casino chip.
And you could argue this right here was the original sin of the whole crisis. We went from a model where your local bank would give you a mortgage and hold on to it for 30 years, so you better believe they cared if you could pay it back, to this new system where they'd sell your loan off within a few days. All of a sudden, quality didn't matter, only volume did. That critical link between the person making the loan and the person taking the risk, it was just severed.
Now here's the first key invention that made all this possible. The mortgage-backed security, or MBS. The basic idea was pretty simple. You take thousands of mortgages, you bundle them all together into one big pool, and then you sell little slices of the combined mortgage payments to investors all over the world. It turned a regular home loan into something you could buy and sell just like a stock.
But of course, Wall Street didn't stop there. They took it a step further with something called a CMO. What they did was slice up that big pool of mortgages into different risk levels, or tranches. Think of it like a layered cake. The top layers, the senior tranches, they got paid first from the mortgage payments, which made them seem incredibly safe. So safe they got AAA ratings, the best you can get. The bottom layers, the junior tranches, well, they got paid last, and they had to absorb any losses first. But here's the key. This whole process didn't get rid of the risk, it just hid it, concentrating all the toxic stuff in those bottom slices.
So now you have this powerful new financial engine, right? But it needed fuel, a lot of fuel. It needed an endless supply of mortgages to keep it running. And a perfect storm of deregulation, cheap money, and global demand was about to provide it in spades, kicking off a worldwide mania.
It really came down to three things. First, deregulation. The government tore down the walls that separated normal, boring banking from risky investment banking. Then they decided that these super complex financial products didn't need any real oversight. Second, you had cheap money. The Federal Reserve cut interest rates down to almost nothing, flooding the world with cash. And third, you had all this cash desperately looking for a safe place to go that actually paid a decent return. And what looked like the perfect answer? You guessed it, those super safe AAA-rated mortgage bonds.
This created an absolutely insatiable demand for more and more mortgages to feed the machine, and it led to a complete, total collapse in lending standards. It got so bad that we ended up with the infamous ninja loan. No income, no job, or assets. Lenders literally weren't even checking if the borrower could pay the money back. The only thing that mattered was getting the loan signed so they could sell it to Wall Street.
Pretty soon, though, Wall Street had a problem. Nobody wanted to buy the riskiest, most toxic slices of these mortgages anymore. So what did they do? They invented the doomsday machine, the CDO. They took hundreds of those toxic, unsellable slices that nobody wanted, bundled them together into a new pile, and then, and this is the crazy part, they sliced up that new pile of toxic waste all over again to create brand new AAA-rated securities. It was financial alchemy. They were literally turning garbage into gold.
And this created a monstrous feedback loop. The CDO created a huge fake market for the absolute worst mortgage bonds imaginable.
That demand made lenders throw their standards out the window to create even more bad loans to sell. And all of that money, of course, just pumped the housing bubble up to a size nobody had ever seen before. The whole system was just feeding on itself. So, what happens when the housing bubble finally pops and people start defaulting on all those crazy loans? Well, the entire unbelievably complex house of cards comes crashing down. And that brings us right back to that one fateful week in 2008.
The collapse happened so fast, it was breathtaking. One week, the government has to take over the mortgage giants Fannie Mae and Freddie Mac. Just a few days later, Lehman is gone. 24 hours after that, AIG, the world's biggest insurer, needs an $85 billion bailout just to survive the day. And by early October, Congress is forced to pass a $700 billion bailout for the entire banking system. It was just one domino after another.
These numbers kind of help put the sheer scale of all this into perspective. Lehman's collapse was massive, sure, but it was just the tip of the iceberg. The real problem it exposed was over $1 trillion in bad subprime loans floating around the system, and it took a bailout fund of historic size just to try and stop the bleeding.
So if you're trying to track how this all happened, this is the key. Each new invention moved things one step further away from the reality of someone's home loan. The MBS turned a loan into a commodity. The CMO created a false sense of safety while concentrating the risk. And the CDO? Well, the CDO just hid that risk in plain sight, creating the artificial demand that blew the whole bubble sky high.
But, this crisis wasn't just some abstract Wall Street event. Its consequences ripped through the real world, through our economy, and honestly, they continue to shape our lives in some pretty profound ways, leaving this long, lingering shadow. When you strip away all the complex finance, the true story of the crisis is its human cost. This wasn't just about banks. This was about almost 9 million people losing their jobs. $13 trillion in family wealth just evaporated. We're talking about millions of foreclosed homes, shattered savings, and an entire generation whose financial future was completely upended. So after the dust settled, the government's big response was the Dodd-Frank Act. It was this massive overhaul of the rules. It created a brand new agency to protect consumers from predatory lending. It put in something called the Volcker Rule to try and stop banks from making huge, risky bets with their own money, and it tried to drag the incredibly opaque derivatives market out into the open. But the aftershocks, we are still feeling them. For millions of people, watching the banks get massive bailouts while they lost their homes created this deep, burning anger and a total collapse of trust in our institutions. And that anger, it directly fueled the populist energy that created movements on both the left and the right, from Occupy Wall Street to the Tea Party. You can draw a straight line from the 2008 crisis to the polarized politics we live with today. Which leaves us with one final and, I think, pretty critical question. Yeah, the system is probably safer today. Banks have more capital, some of the craziest products are gone. But the fundamental forces that drove the crisis, greed, complexity, the belief that you can just engineer risk away, those things never go away. So has enough really changed to stop it from happening again? Or are the lessons of 2008 already starting to fade?